So in this video, we're going to take a look at 4 tips on buying call options. Some of them, some people may know, some of them you might not have heard of before. So my goal is to kind of open your eyes a little bit to give you some insights on trading call options. So if you're brand new to trading options, I highly encourage you to check out the tradersfly.com website. There's a lot of great mini courses out there, detailed courses, freebies, guides, PDFs, you name it. There's a ton of knowledge and information there. So check that out. Anyways, let's get started. We're going to go into some call option concepts. Of course, some of this might scratch the surface because we're on YouTube. For others of you, this might be really confusing. So I'll give you some insight as best as I can in the short form video on YouTube, and then you can evolve things further on our website. All right, so number one, when it comes to tips, most buy shorter duration. I'm going to say that's probably not what you want to do. When we look at shorter duration options, when you're a buyer, you typically want the gift of time. You typically want to buy more time. What happens is when people buy shorter duration option contracts, let's say we're taking a look at Tesla, which is a very popular company at the moment, and we buy short duration. Let's say we go to a 10-day option here and we buy this single option contract. Well, when you look at this, you might say, hey, this is a good thing because I'm looking at this option contract and I think in the next 10 days it's going to go higher. But let's ramp it up to 10 contracts. What's going to happen is the theta decay against you is a negative 450. So that's pretty significant, which means you're losing $450 a day. Now, if I take that same option contract and let's say go to about a November, yes, I'll have to pay more for the option contract, but my theta decay is a lot smaller. So in other words, this is one of the reasons. The other reason is that when you only have 10 days, that option, the chance of it kind of going against you is quite high and significant. So be very careful with that when you're doing with shorter duration. I will say in most cases, shorter duration is good for selling, longer duration better if you're a buyer because you need the gift of time. You want things to work out or pan out in your favor. All right, let's take a look at number 2. Theta decay is fast for at-the-money call options. So a lot of people, when they go into buying an option contract, I'm going to switch this to option theories and theta, the Greeks, so theta decay. A lot of people buy right at the money. And the problem with at the money is you're losing about 30 cents a day here for the at-the-money options. So at-the-money options are not always wise from a theta-based perspective. Now, if you're doing things more non-theta based, like if you're looking at other concepts like a delta or so on, that's a different story. But if you look at it, all the sweet juice is in the at-the-money options, which means if you're a buyer, this can hurt you. If you go a little out of the money, you don't lose as much theta. If you go in the money, you don't lose as much theta. So at-the-money options are usually not the wisest choice if you're thinking and worried about time. So be aware of that. Let's go to tip number 3. Your probabilities are lower than you think. Okay, so if we go to a 30-day option contract, most people think that if I get this option contract at 265, that my chance of winning this is 50-50, but they are very wrong. And the reason they are wrong is because they don't take into account the premium here that they make, because you have to take into account the premium. And the premium is the premium you pay. So the current stock price is $269.30. And it's wiggling around. And here we are at right around 270. So if we get to 270 or 265, you might think that, hey, we have a 50-50 shot. But when you really look at it, let's switch this to a buy. Let's go in here to the 270 because we're close to 270. It's 269. So if we get to 270, we're paying $16 for this option contract. But if you look at the break even, if we analyze the break even for this option contract, it's going to be the 270 plus the $16 I pay. So that should be around 270 plus 16, so that'll be about 286. And take a look at that. I have to go right here, 286 right there is that option contract at break even. So you can see right there. Now, that means you have to look at the 286 for your probabilities. So your probability right here, if we switch this theta now to probability of in the money, okay, now 286, we'll go to 285. 285 is actually only about 32%. Most people get this one and they think, I got a 50-50 shot. If it goes up, great. If it goes down, that's fine. But I got a 50-50 shot because they're right at the money. But that's not true. That's actually your probabilities. You're not taking into account the premium paid, and you have to look at the 285s, which actually gives you only about a 32% chance of profitability or probability of profitability in that case. So be very careful in those cases. All right, and tip number 4 is going in the money is often better than at the money or out of the money. So I misworded that one. So let's try that again. Here's number 4, going out of the money. So going in the money is often better than at the money or out of the money. So many people, they try to do the option contracts over here. They try to go out of the money. Some of them will go at the money. But in many cases, going in the money is often better. And yes, it's more expensive. There's a cost. There is a trade-off. But what happens is this is more like a stock equivalent. If you go in the money, you're dealing with more of a stock equivalent. Whereas if you go out of the money or at the money, you have a nasty theta decay. So here we're decaying about 24 a day, and my delta is around 66. So if this moves, it moves immediately. It almost is like a straight line. Whereas if I go more around a 270, my theta is actually quite a bit more. So from 24 it's 26. You might say it's not that much more. So let's do this. 262 versus maybe 219. So it's quite a bit different. Okay. So, and what happens with the delta is, look, your delta here is 622 versus, okay, 750. So you can see you're getting a lot more delta in this case. And also you'll have some salvage value or some value if the stock goes against you. And here, if we go even further out of the money, let's say 285, now for you to start making money, you have to make up this slow acceleration. So the further you go out of the money, what happens is these options, they're slowly picking up speed, and then they really accelerate. Whereas if you go 260, you're already getting a quite accelerated move. So the downside is you get slow acceleration with the out of the money options. Yes, they're cheaper, but the problem is if they move, you got to have them move a lot to really pick up speed, but they're cheap. So that's the trade-off. They're cheap, but for them to really move and react, you need them to move fairly quite a lot. So anyways, that's what I wanted to show you. Those are kind of my 4 tips for you in terms of looking at trading option contracts. So continue to study, continue to learn. Check out our website at tradersfly.com. I think you'll learn quite a bit there, and check out some of the freebies and things we have available. So I'll see you later in the next video. Take care.